This is Matthew Kratter's Bitcoin University. Today we're going to be talking about making U.S. toxic debt taste yummy again. We're going to be talking about US Treasuries, Bitcoin, and this new concept of BitBonds. So as everyone knows, the U.S. has a lot of debt, including unfunded liabilities. It's something like $200 trillion in debt, but just the public debt portion of it is currently $36.5 trillion and going up every day. So the U.S. has a debt problem. It also has a refinancing problem. About $7 trillion worth of that debt needs to be refinanced in 2025. In other words, there needs to be new bond sales that raise money to pay off the old bonds. So if you want to talk about Ponzi schemes, the real Ponzi scheme is not Bitcoin. The real Ponzi scheme is the US dollar and US government debt. But there is $7 trillion worth of debt that needs to be refinanced and rolled in 2025. And then there's probably, if we take a look at the deficit here, we're running currently a $2 trillion deficit. So that's $2 trillion more debt that needs to be issued. So that's about $9 trillion that the market has to absorb in 2025. This is a problem. This is a can that's been kicked down the road, especially by Janet Yellen, who is completely incompetent and did not issue more longer maturity, longer duration debt back when interest rates were lower. This is a mistake that Steve Mnuchin made as the previous Treasury Secretary before Janet Yellen. And it's interesting Yellen did this, though, because this basically kicked the can and made this whoever is going to be the next president's problem, currently President Trump's problem. So that's the problem we have, and interest rates have moved up. The U.S. is currently paying much higher interest rates on this new debt because the Fed raised rates, and also the market in terms of the yield curve has moved upwards. So that's a real question. Who's going to buy all of this debt? We could ask China. We could say, hey, China, will you lend us money that we can use to pay Chinese factories to make military supplies that we can use if we ever need to fight a war against China? This has basically been U.S. policy for the past decade, and it's complete insanity, using our potential geopolitical rival to finance our military spending. This is why we need to bring back a lot of manufacturing to the U.S. It's not just an economic decision, it's also a national security decision. Keep this in mind if you think that tariffs are a completely dumb idea, because you might only be thinking about the economic piece and not the national security piece. So China has gotten very smart after the great financial crisis and all the quantitative easing and money printing that took place. They realized that they probably shouldn't be sending us goods and services, especially manufactured goods, and just getting pieces of paper instead. So Chinese holdings of U.S. government debt really peaked in late 2013, early 2014, and has been declining ever since. Now, we've been talking about alternate ways for the U.S. to finance itself, especially by issuing short-term debt, because this is the path that Yellen and Mnuchin got us on. One path that we've spoken about is issuing more stablecoins, U.S. dollar denominated stablecoins that are backed by U.S. T-bills, U.S. Treasuries that have a very short maturity of 1 year or less. And this is one way of spreading dollar dominance, which is one reason I'm not a huge fan of it. But this is something that USDT does, that Tether does. They have been buying up a lot of U.S. government debt. So that's on the short end of the yield curve, the 1 year maturities. But how can we term out our debt and sell more 5-year or 10-year debt and sort of spread this financing out? U.S. Treasuries almost never preserve your purchasing power, meaning that your returns holding them are usually much less than the rate of inflation. So the question is, who's going to be stupid enough to buy this toxic debt? China's not interested in buying anymore. They've just constantly been shrinking their holdings. Now, some entities are actually forced, some domestic entities in the U.S. are actually forced by the U.S. government and its regulators to hold a certain amount of this debt. Banks and thrifts, insurance companies, pensions. And it's funny to think about this, because what we're seeing here is really the quintessential crime cartel tactic. Really nice business you got there. Would be a shame if you didn't buy our paper and something happened to your business. So some of this can be regulated. They can regulate these companies to put this toxic debt that doesn't keep up with inflation on their balance sheets. And then, of course, everyone who's holding a pension or has an insurance policy possibly suffers from this. If you're enjoying this video so far, I just ask you to help to support this channel's educational mission. Hit the subscribe button. That does really help the channel and its reach. Leave a like, leave a comment, question, suggestion for a future video, and share this video with a friend or family member. These strong-arm mafia tactics are working much less well for the U.S. government these days. So now there's talk of perhaps using fewer sticks and more carrots, what you might call sweeteners. So for example, when you buy a new car, the dealer might throw in a sweetener in order to get you to accept and purchase the car to purchase at a certain price. pay $48,000 and we'll throw in free wheel locks and heavy-duty mats or something like this. In finance, you also have something called sweeteners. You can, for example, have a sweetener where if you buy these shares of stock, we'll throw in some warrants, which is a type of call options. So let's say you're a holder of the stock at $100. You get paid $5 annually. That'd be a 5% dividend yield. Adding a sweetener to this would be adding a call option or what's called a warrant. Let's say that it's struck, it can be converted to stock at 110. So if you own a warrant struck at 110 and the stock hits 120, you can then sell the warrant or exercise it at 110 and then sell the shares at 120 for an extra $10, which is a lot of money if you think about it, because that's double the 5% yield you were making per year just from the dividend. So this is what a sweetener is. It's just an enticement to buy. BitBonds are U.S. government bonds, US Treasuries with a Bitcoin sweetener. It's a great name for it, I think, BitBonds. Andrew Hones of New Market Capital did a great presentation on this idea of BitBonds at the Bitcoin Policy Institute a few days ago, so I will link to that video in the description notes below. There are many different ways you could structure these BitBonds. I'll just follow along with his suggestions, but you can understand that these are obviously, you can change the parameters if you need to. So this is what it would look like. Let's say the U.S. federal government issues or sells $1 trillion worth of 10-year U.S. Treasuries. They want to go out 10 years. The T-bills can all be bought by Tether and USDT, but if you want to sell it further out, you'll do 10-year Treasuries, and so you need to find a buyer for this that's maybe not China. Interest rate on this debt would be set at 1%, which is well below the current market rate of 4.3%. That's where the market is currently pricing these 10-year notes. These would mature in 10 years, as we said, because they're 10-year treasuries, and they would raise $1 trillion, of which $900 billion would go to the U.S. government right now to pay off existing debt. This is what it means to roll the debt, or to use for current year spending to use in the federal budget. And then $100 billion, in other words, 10% of it would go to buy Bitcoin. And that's a lot of Bitcoin, $100 billion worth of Bitcoin. That's about 6% of the current Bitcoin market cap. And as you buy Bitcoin, obviously, the price goes up. And so this would have a huge stimulative effect on the fiat price of Bitcoin. Now, holders of these BitBonds, holders of this debt, would get a much lower interest rate than the market rate. They'd get 1% instead of 4.3%. That's actually a great thing for the U.S. government, because it's just in that process, it reduces its interest costs by 75%, taking them down from 4.3% if they issue new debt at market rates down to this artificially engineered 1% interest rate. So that's a 75% savings on interest costs. The interest on in terms of the federal budget deficit is currently about $1 trillion a year. So imagine if you could reduce all of that down by 75%, you'd be saving $750 billion a year. So these are huge numbers. Now, the problem is this is not so great for holders of these U.S. Treasuries, because they're getting paid 1% and inflation is obviously much higher. And if they bought a plain vanilla U.S. Treasury note, they'd be getting 4.3%. So how do we make them whole? What we do is we give them another form of a sweetener, this time in the form of Bitcoin. So holders of debt will get to keep 100% of the upside price appreciation of this Bitcoin. Remember, we're raising $1 trillion here, and $100 billion is going to buy Bitcoin. So holders of these U.S. Treasuries, these U.S. BitBonds, would get to keep 100% of the upside price appreciation of this Bitcoin over the next 10 years, payable at the bond's maturity, I assume, up to the point where their 1% compound annual growth rate, their 1% CAGR, turned into a 4.5% CAGR. So they'd be getting a little bit more than the market rate of 4.3%, assuming Bitcoin goes up enough to generate that CAGR. After that, these bondholders, these BitBond holders, would get to keep 50% of the Bitcoin's price appreciation upside, and then the U.S. government would keep for itself the other 50%. So what's happening here? The U.S. government is using potential Bitcoin price upside as a way to finance its debt at much lower interest rates. The big question is, will holders trust the U.S. government to make good on its promises? The U.S. government in the past has already defaulted twice, at least, that I can think of, on its debt, when that debt was backed by another commodity, namely gold. Roosevelt in 1933 and 1934 refused to pay out some bondholders. They were owed gold or silver. And then, of course, in 1971, the entire convertibility of U.S. dollars, and hence U.S. debt into dollars, into gold, that convertibility was severed. So if you're holding these BitBonds, you are making a bet that the U.S. government's not going to change the rules halfway through the game, as it did in 1933 and 1971. But again, they're probably worse borrowers in the world than the U.S. government. Bitcoin can be held, the Bitcoin that's purchased as part of these BitBonds, it can be held in the Strategic Bitcoin Reserve, and it can be verified on-chain if necessary. So this is much better than a BitBond backed by gold, for example, which is very difficult to verify that the gold actually exists and is there. And of course, we have no idea what's going on with Fort Knox. This is an example of this. So I think BitBonds are a clever idea. They're definitely worth trying. It's also a really clever way to buy Bitcoin for the Strategic Bitcoin Reserve in a budget neutral way. You can see here this doesn't blow out the budget deficit, but it still allows approximately $100 billion worth of Bitcoin in this case to be deposited in the Strategic Bitcoin Reserve. So these are huge amounts of Bitcoin that would be bought. Now the next question, should you and your family buy BitBonds? I personally don't think so. It's not financial advice. That's just my personal opinion. I think BitBonds are like crap donuts with a chocolate filling. If you have a choice, why not just get the chocolate filling part and stay away from the crap part? You don't really need U.S. government bonds. Though if you still doubt that the U.S. government's going to buy a lot of Bitcoin, I think BitBonds and this presentation are yet another reason you shouldn't be so bearish. I think we definitely see something like this in the next few years or some alternate version of it. If you enjoyed this video, be sure to hit the subscribe and like buttons. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.